Understanding the key differences between supply and demand zones versus traditional support and resistance is crucial if you want to read the market's language fluently and trade with an edge. In this exciting chapter of our Smart Money Concepts course, that's exactly what we're going to explore. Hello and welcome back to another video on the ComLucro channel. This video shows how to identify strong supply and demand zones using smart money concepts, use fair value gaps, validate zones through structural breaks, and draw them correctly on the chart. It also covers the three main zone types and entry techniques with better pricing and confirmations, helping you trade in line with institutional flow. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let's start with the basics, understanding support and resistance. Support and resistance are zones where the price has reacted previously and may react again in the future. On the chart, you can see the price pushing up, hitting a certain area, and reversing. This area is known as resistance, indicating that sellers have initiated short positions while buyers have closed their long positions, causing the price to reverse. Similarly, when the price pushes down, hits a particular area, and reverses, it creates a support zone. This indicates sellers closing their short positions and buyers opening long positions, which causes the price to reverse from this area. Next, let's discuss why we should mark these zones on the chart. Here are three crucial reasons. First, levels where the price has previously reacted are likely to be rejected again, so we observe these levels closely for potential rejection. This helps set profit targets, especially if they are key levels on higher time frames, as even minor reactions here can lead to major reversals in lower time frames. Second, determining market direction. When the price breaks through a resistance level, it shows that buyers have overpowered sellers, indicating bullish momentum and a potential upward continuation. Similarly, breaking below a support level indicates bearish momentum, so we align our trades with the dominant trend. Identifying the direction is the first step when we open the candlestick chart. Third, identifying liquidity. We know that when the price reaches support and resistance levels, price action traders seek trading opportunities. Break and retest traders will buy if they see rejection signs in the zone, placing their stops below this level, anticipating upward continuation. If there isn't enough liquidity to push the price higher, the market might break below this level, grab the liquidity, and continue rising. So having our entry below this level can provide double confirmation of the moves we anticipate. Traditional support and resistance are also considered liquidity areas. Now let's explore supply and demand in smart money concepts. Supply and demand areas form when smart money enters the market, causing significant price movements. A demand zone cannot be identified when multiple small candle rejections occur, but a valid demand zone is confirmed by large candles indicating strong buying pressure. These momentum candles suggest the presence of large institutions, banks, and hedge funds, essentially the smart money in the market. Similarly, a valid supply zone forms when there's aggressive bearish momentum. So how do we gauge the aggressiveness of price movements? By identifying fair value gaps on the chart. We won't go into detail here on how to perfectly identify a fair value gap of 3 or 4 candles, as we have a specific and detailed video on this topic. I invite you to watch that video for a deeper understanding. Continuing on, the larger the gap, the more aggressive the movement, indicating an imbalance between buyers and sellers and the entry of significant money into the market. Typically, prices revisit these areas to fill orders left behind, restoring balance. Another key factor in validating a supply or demand area is the break of a structural level to confirm momentum, providing crucial insights for making informed trading decisions. If you're not familiar with market structure concepts, check out our previous videos on the topic. The links are in the description. Next, let's discuss how to draw supply and demand zones on the chart. Let's start with the basics. Identify fair value gaps and breaks on the chart. When we find a move with these criteria, we mark the demand zone by drawing a rectangle from the high to the low of the last candle that created the fair value gap. The same applies to bearish scenarios, regardless of the candle's color. Mark the last candle that created the fair value gap as the supply zone. Traders have various methods to mark these zones, but the key point is to place your stop loss in a safe position to protect against market fluctuations. We classify supply and demand zones into 3 types based on market structure: order blocks, order flows, and consolidation areas. Order blocks are optimized supply and demand areas with aggressive buying and clear fair value gaps, leading to a break of structure. The latest candle creating the fair value gaps is marked, and the liquidity sweep below this candle is noted before the price takes off. When placing a buy limit at this order block, the stop loss should be below the wick where the movement started, incorporating this area into the order block zone. As the price corrects, we enter positions when trading opportunities arise. If the last candle creates inefficiency, we place the stop above the swing high for protection, expanding our trading zone and stop. Sometimes, order blocks form with opposite colored candles in the midst of heavy movement, utilized by institutions and big players to fill remaining orders. We consider these order blocks and look for trading opportunities upon the price's return to these levels. Next, let's discuss the second type of supply and demand zone: order flow. Order flow represents areas where buying or selling pressure built up before an aggressive market movement. The bullish order flow is where the last bearish pressure occurred before the bullish move, and vice versa for bearish order flow. These areas are crucial in smart money concepts. For example, a move creating fair value gaps and breaking structure includes the last bearish momentum before a drastic move, forming a large zone often containing an order block. Monitoring market structure closely is vital for optimal trade execution. Finally, consolidation areas are key supply and demand zones. These occur when buyers and sellers lack the strength to drive the market into a trend, causing the price to oscillate within a range. Liquidity accumulates, potentially leading to a breakout. Consolidation zones become crucial supply or demand areas for traders, provided there is an imbalance. For instance, if the price consolidates during the Asian session and London liquidity enters, this consolidation zone becomes an ideal demand zone for long opportunities. The stop is protected above the zone, with multiple targets set. Similar to order flow areas, consolidation zones can be large, requiring careful trade entry to avoid an extensive stop loss. Now, let's explore some techniques to enter trades at better prices. We aim for trades with at least a 1-to-2 risk-to-reward ratio before reaching the first target, usually the latest high. Setting entry at the start of the order block and placing the stop below the swing low provides breathing room for the price. For larger order blocks, position the stop below the zone's end. 2 entry techniques are useful for large order flow or consolidation zones. First, enter at the middle of the zone with the stop below, reducing the stop by significant pips. This optimizes entry and exit points. Second, wait for confirmations in lower time frames, our preferred method, since even strong trading zones might break. We've covered various lower time frame entry techniques, like change of character entry or retracement levels. When the trading zone is large, we require more confirmations, as the market tends to take out early buyers and sellers. Entering a large demand or supply zone often results in false signals before reversal. Hence, double confirmation is necessary. After a change of character in a downtrend, if the price breaks previous market structure highs, indicating a possible reversal, we look for rejections from the recent demand area. If false, the market continues lower. Double confirmation involves waiting for the price to break the new high and form a new structure level, ensuring the change of character and structure continuation. As usual, let's open the chart for a step-by-step analysis of trade opportunities. On the 1-hour chart, breaking above a key level suggests upward continuation. Fair value gaps show bullish momentum, And the order block offers a perfect long opportunity. Zooming out to the 4-hour chart, we see a critical higher time frame level often rejecting the price. However, weakening rejections indicate a possible break to the upside. The anticipation is for the price to hit the recent highs, even if a reversal occurs. So, we open a buying position on this order block, placing the stop below and targeting the latest high. The order triggers during the high liquidity London session, another confirmation of the anticipated move. To wrap it up, today's video has given you a clear and structured walkthrough of supply and demand areas within smart money concepts, showing how they differ from traditional support and resistance. We explored how to identify high-quality zones, use fair value gaps, and confirm entries on lower timeframes to strengthen your overall edge. These tools help you align your trades with institutional flow and stay in harmony with the true direction of the market. Before we close, take a moment to reflect on one essential point about emotional management. Many traders fail not because their strategy is weak, but because they underestimate how losses affect their mindset and decision-making. What happens inside your mind during a drawdown matters far more than the loss itself. To reinforce this idea, we're going to show a short clip from our video, How Beginners Can Learn the Discipline of Millionaire Traders. In this clip, you will see the first 2 foundational steps to develop the mindset of a millionaire trader. Even though the full video goes much deeper into the complete process, let us take a look. Step 1 is awareness. Change begins the moment you notice yourself. Awareness starts in that split second before you click buy. Ask yourself one question: logic or impulse? If the answer comes from emotion, the outcome is already decided. Research from UCLA on affect labeling shows that naming an emotion reduces its intensity. When you name what you feel, you take back control. Awareness breaks the loop. It is how you stop trading for stimulation and start trading for mastery. Step 2, replace the reward. This is the mind reprogramming. Most traders celebrate profit, but professionals celebrate discipline. When you say, nice, I made $100, your brain releases dopamine for the money. But when you say, nice, I followed my setup, your brain releases dopamine for control. You are teaching your mind to feel good, not when you win, but when you do the right thing. And as authors like Mark Douglas note, discipline is the real flex. This is how you rewire the reward system. You make consistency feel like victory. That clip is a timely reminder that consistent results come from discipline, not emotional reaction. The best traders stay grounded, keep structure, and treat trading what the serious performance activity it is. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.